is a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100, people said, here's this great company, great record. If it ever gets below 100, just buy every share, and it did get below 100. A lot of people bought on that basis, saying, look, it's gone from 135 to 100. It's now 95. What a buy. Within a year, it was 18. And this is a company with no debt. I mean, this is a company, it was just so overpriced.
So what has been your single biggest mistake you've made, either investing in a company or deciding to walk away from investing?
We spent an enormous amount of time looking at MasterCard before it went public. And I've always believed that, I'd said previously, I was asked by, at a business school by a student, what's the single best business in the world? And I said, if you could own a royalty on people spending money, like Visa or MasterCard, it's the greatest business in the world, and if that ever became a public company, you want to buy that company, or if you ever could buy that company. Well, it became a public company, and we did an enormous amount of work on the company. We couldn't get comfortable with the regulatory risk.
I think you can do very well as a stock market investor if you find really high quality companies and you buy them at attractive prices. And I think today, is a pretty good time. It's a pretty good point of entry, right? March of 20 was obviously a very, very good entry point. And anyone who bought stocks in March of 2020, something I went on TV and advocated, I said, this is a moment. I think this is sort of another moment where I don't know how well you're going to do over the next 3 or 6 months, 12 months. It's a highly uncertain world. But over the next 3, 4, 5, 10 years, it's a pretty good place to be an investor, or time to commit more capital to equity markets. Although you got to pick carefully. You want to own the super high quality, well capitalized, dominant businesses that will be here, 30 years from now. And that's what we own.
I think is an interesting one about the modern life. But this goes back to a different time. And this man has this wonderful horse. And it's just a marvelous horse. It's got an easy gait and good looking and everything. It just works wonderfully. But also occasionally just gets so he's dangerous and vicious and causes enormous damage and trouble and breaks arms and legs for his rider and so on. And he goes to the vet and say, what can I do about this horse? And the vet says, that's a very easy problem and I'm glad to help you. What should I do? And the man says, the next time your horse is behaving well, sell it. Well, think of how immoral that is. And haven't I just described what private equity has to do?
With earnings this week that were better than expected, iPhone sales were still a little weak. The street loved what they saw. What did you think?
I like what I saw, too. It is an unbelievable company. I think it earns almost twice as much as the second most profitable company in the United States. It's a wide gap. I mean, it's an amazing business. Here's a company that's earnings are $60 billion, whatever, and you can put all their products on a dining room table. I mean, that's not the way it used to be in this country. I mean, it is incredible to me. You read all the analyst reports, and they talk about what it's going to do next year. Nobody buys a farm based on whether they think it's going to rain next year, right? Because they think it's a good investment over 10 or 20 years. So the relevant question, when you're looking at buying part of a business, which you're doing when you buy a stock, is where's it going to be in 10 or 20 years? It may be that you don't know, in which case you don't have to do anything.
Value fund managers say is the way they're able to make returns for you is by buying significantly cheaper stocks and waiting for that re-rating. Is there a risk then with your strategy that you're paying over the odds, that these stocks are expensive?
Yeah, you're right. That's how some value fund managers seek to do it. I have to say, looking at the average results of the industry, not very many of them seem to manage to achieve outperformance with that. And one of the problems with that strategy is this. If you buy your poor company, apart from the fact that it does destroy value whilst you wait, if you get your timing roughly right, yeah, it'll make some value for you. It'll create some performance for you. The problem is then you have to go find another one. Whereas with our companies, if we select them right, we never have to go and find a new company. We can sit there, not deal, and as a result, cut down the costs of running the portfolio.
One of the key measures we look at is the free cash flow yield of these companies, which sounds a little technical for the non-investment professional, but isn't really. It's the amount of cash that the companies generate after all their expenditures each year, divided by their market value.
Say, people ask me what I learned from George Soros. I thought when I went there I was going to learn what made the yen and the Deutschmark go up and down and that kind of thing. No, what I learned was sizing is probably 70 to 80% of the equation. It's not whether you're right or wrong, it's how much you make when you're right and how much you lose when you're wrong.